Just too big a deal. That's the verdict of the ACCC on National Australia Bank's proposed takeover of AXA Asia Pacific. NAB has been trying for months to get past the regulators, even offering to sell some of the newly acquired assets. But in the end, the deal would have left the bank with a slice of the market that's just too big. Andrew Robertson reports.
At $13 billion, National Australia Bank's bid for the Australian assets of AXA Asia Pacific is the biggest financial services sector deal the competition regulator has knocked back. It's been a year-long process, and while naturally disappointed, NAB remains philosophical.
Well, we thought we'd put together a pretty good package in consultation with them to address their concerns. That hasn't been the case. So from here now, we just need to sit back, see if there are any other options for us in terms of dealing with the ACCC, and in fact other options, for example, walking away or taking further action, and we'll work that over the next few days.
The ACCC first rejected NAB's takeover of AXA back in April. Today's decision was its verdict on undertakings from NAB and AXA aimed at getting it to change its mind. In the end, the regulator decided NAB's offer to sell the administration business of AXA's North platform did not provide sufficient certainty that the ACCC's competition concerns will be addressed. University of New South Wales business law expert Michael Peters believes it's not just a rejection of NAB, but a warning shot for all the big banks.
It's fairly clear that the ACCC is taking a very strong line in the banks solidifying their position in the marketplace. The big four are not going to get any larger, and they're not going to get any larger, particularly in the wealth management sector.
AXA Asia Pacific shares tanked on the decision, dropping 10% at one point before ending the day off 7%. The company's only comment so far is that it notes the decision and is considering the implications. AMP, which made the first bid for AXA last year, which was rejected, described the ACCC's verdict as the right outcome for consumers and competition. It says AXA remains strongly attractive, but on the right terms. Not everyone is impressed with how the Australian Competition and Consumer Commission has handled the NAB-AXA situation. Tony Senna from Selector Funds Management believes NAB should have been given clearer guidance on what was required to alleviate competition concerns.
In the scheme of simply saying to National, go away and come back with a better offer, that may be okay to do that, but I think perhaps to get a positive outcome, perhaps they should be given very specific and clear directions as to what to do.
While AMP remains interested in AXA Asia Pacific, Selector Funds Management's Tony Senna believes it's a deal which could break the company. He points to AMP's prolonged underperformance, which is reflected in a share price now roughly a fifth of what it was when AMP listed nearly 13 years ago.
The case with AMP is that they've tried acquisitions in the past and they haven't necessarily delivered where it counts, which is the bottom line. So I do think that there is certain risk here.
The question now is that risk one AMP is willing to take?